while inventory to sales levels are still depressed relative to pre-pandemic, our next guest is keeping tabs on February retail sales set to come out next week, as they are likely to be a key indicator for what the Fed might do later this month. For more, we welcome in Jennifer Lee, BMO Sr. Economist and Managing Director. Jennifer, thank you so much for being with us. Happy International Women's Day. And tell us a little bit about your expectations for retail sales. I mean, it is one data point. It is nominal, so it's not adjusted for inflation. But what are you expecting this data point to tell us?
Well, good morning. Happy International Women's Day to you both and to everyone. Thank you for having me on. So next week, it's going to be the second of three key indicators that the Fed is going to be watching for. I thought it was interesting how yesterday he said that there are 3 data points, or actually said 2 or 3 data points that will help guide their decision. Obviously, we know that payrolls on Friday will be one, retail sales and CPI will be the other. So retail sales, I mean, we did see that big bounce of about 3% on all the main measures or main components of the survey. Looking for some pullback. Obviously, there is some weather-related bounce from that, which the Fed chair alluded to yesterday. But I think overall, we're going to probably see overall slowing growth. You know, the consumer is, as you were just mentioning, with the inventories data, you know, the consumers have a lot of stuff already, and prices are going higher. So they are starting to slow that spending down, which is, you know, completely understandable, just given how much interest rates have risen.
And Jennifer, it's Julie here. Good to see you. Happy International Women's Day to you as well. So I was just talking about sort of normalization, right? That we have seen this more normalization on the retail side. And some of that is as we have seen spending shift to services, right? Some of it is as people are just buying different stuff or not buying as much stuff. I'm curious, when are we going to see normalization maybe on the services side as well, which presumably would help with the inflation equation?
So that's the big question. And when you're talking about normalization, in my head, I was thinking, I don't even know what normal is these days. It's been all over the place. But, you know, I mean, we already saw the pullback in goods because, again, you know, everyone has enough stuff. But there's still that big push for services, for travel, for dining out. That's still going on. But again, we have seen a slowdown overall, and especially in discretionary spending, such as dining out, such as, you know, like recreational services, for example, even clothing, things like that, where you can actually pull back a little bit and not change your lifestyle too much. So we're starting to see some pullback on that. And of course, the higher rates go, the more prices or the more prices are rising, the more expensive it is going to be to, you know, engage in this discretionary spending. So that's where we're going to start seeing some of that pullback. You know, how long that's going to take is anyone's guess right now, but it sounds like it might even come sooner if the Fed does start ratcheting up its interest rate, its Fed funds forecast or Fed funds target a little bit faster than, you know, that we had been anticipating, say, like a week ago.
And just off of that, I mean, there have been certain forecasts that have been upped after Jerome Powell spoke yesterday. So tell us a little bit about your takeaways about what you heard. Do you think that there's a case for the Fed to be increasing rates by 50 basis points at its next meeting? And what are you expecting? How are you expecting the economy to react?
Lots of questions. So let me try to. Okay, so first of all, it was a super long testimony yesterday, and luckily, the biggest takeaway I got from it came up right up front in his written testimony when he said that if the totality, I think that was if the totality of the data continuing to warrant faster tightening, then they are prepared to increase the pace of rate hikes, and that was the key message. I thought it was also very interesting that he did not dismiss the strong data of late. You know, a lot of analysts did as well, but he didn't dismiss it completely. He said, yes, some of that could have been due to unseasonably warm weather, but he was more taken back, I think, by the breadth of the increase in the revisions of the back data. And as well, you know, again, he's looking for key pieces of data to help guide their decisions in coming months. So is 50 basis points possible? You know, anything is possible at this point. You know, it's going to fly against what they said before about how that it's time to start moderating the pace of rate hikes. But again, if the data dictate otherwise, they're going to have to shift their focus and possibly put in another 50 basis points.
Whether it's 50 basis points or not, if the terminal point is 5.5 to 5.75%, Jennifer, Does that mean you now have to redo all your calculations for whether we're going into recession?
I think it will. We've been looking for like a few more rate hikes, and again, we're going to make our final decision this Friday after the payroll report. But certainly, the more aggressive the Fed is going to be, either doing a series of 25s or doing more than 25, even doing 50, that will suggest that the economy is going to be coming in for a perhaps not much of a mild landing, but more of I'm not going to say hard landing either, but it's going to be more of a bumpier landing than, again, we would have anticipated, say, like half a year ago.
Jen, good to see you this morning. Thanks for being here. BMO Senior Economist Jennifer Lee.